Imagine this. You're staring at a 45th floor balcony on the Las Vegas Strip, the same unit that sold for 7 figures just 3 years ago, and right now the owner is literally begging strangers online to take it off his hands for less than the price of a loaded Toyota Camry. That's not hype. That's not exaggeration. That's happening today in 2025, and almost nobody in the mainstream is screaming about it yet. If you own a Vegas condo, if you're thinking about buying one, or if you just love watching real estate train wrecks in slow motion, smash that like button, hit subscribe, and turn on notifications. Because in the next 12 minutes, I'm going to show you hard data proving the Las Vegas condominium market is in full-blown freefall, and it's setting up to be even uglier than the 2008 bloodbath. Drop a comment right now and tell me if you think Vegas bounces back in 2026, or if this is the start of another lost decade, because your comments fuel the algorithm, and I read every single one. Let's rip the Band-Aid off. As I'm recording this in November 2025, there are over 2,300 unsold condos sitting empty across the valley, a whopping 60% jump in inventory in just 12 months. That's not a healthy correction, that's not seasonal, that's the highest pile of unsold units we've seen since the Great Recession. Days on market have exploded from under 30 to pushing 120 in some towers, and in the high-rise corridor along the Strip, the numbers are grotesque. Almost 500 units chasing fewer than 40 closings in an entire month. Do that math. At the current sales pace, it would take well over a year just to clear what's already listed. And every single day, more desperate sellers are dumping fresh inventory onto the pile. The headline median price might still look okay on some websites because banks and owners are holding zombie listings. But dig into the actual closed transactions and you'll see units in buildings like Signature at MGM, Trump Tower, Palms Place, and Turnberry trading hands 20, 30, even 40% below their 2022 peaks. Luxury units that were asking $3.5 million at the Waldorf Astoria are quietly closing closer to 2.8, or just sitting stale with 6-figure price cuts that still aren't moving them. What's killing this market faster than anyone wants to admit is the HOA death spiral. Owners who thought they bought a cash flow machine are now bleeding $1,000, $1,200, sometimes $1,600 a month in association fees before they even click on the mortgage app. That's $18,000 to $20,000 a year vanishing on elevators, insurance, and landscaping, and those fees have spiked 20 to 30% in the last 24 months alone because every boom-era tower built between 2004 and 2009 is suddenly hitting the age where everything breaks at once. Roofs leak, chillers die, fire suppression systems fail state inspection, and boom, here comes a special assessment for $5,000, $8,000, $20,000 per door with zero warning and zero vote. Miss a couple of those payments in Nevada, and the HOA can slap a super priority lien that wipes out your first mortgage and foreclose faster than the bank even knows you're delinquent. Notices of default are already running 28% higher year over year, and that's before we even hit the winter layoffs on the Strip. Meanwhile, the rental rescue fantasy has completely imploded. Vacancy across the valley is pushing double digits, almost double what it was in 2022, because 12,000 brand new apartment units flooded the market at the exact moment tourism softened and convention attendance started sliding. All those Airbnb warriors who loaded up on condos planning to rent to nurses, bachelor parties, and EDC kids are staring at calendars that are bleeding red for months at a time. Average condo rents near the Strip have fallen 6 straight months, and landlords are now throwing in 2 months free, paying broker fees, even offering to buy the tenant's furniture just to get a body in the unit. Short-term rental regulations got tighter, insurance doubled, and the California exodus that was supposed to save everybody slammed shut when tech stocks tanked and Bay Area houses started losing value again. Those remote workers who were paying cash over asking in 2021 are now underwater on their own primary homes and can't move even if they wanted to. Developers see the writing on the wall and have completely frozen new construction. The condo pipeline after this year is essentially zero. No new high-rise projects are breaking ground, and the same builders who kept pouring concrete through every previous slowdown are now walking away unless someone prepays 70% of the units, which nobody is doing. Institutional players like Blackstone and a few hedge funds that scooped up hundreds of units at the bottom in 2020 and 2021 are quietly liquidating positions off-market so they don't spook the retail owners still holding the bag. You won't see big press releases, but check the county recorder. The smart money is already gone. The scariest part is how fast the psychology is flipped. 2 years ago, buyers were waiving inspections, writing love letters, and bidding 50 grand over asking sight unseen. Today, open houses are ghost towns. Price cuts hit every 2 weeks like clockwork, and realtors are cold calling expired listings, begging for any offer above foreclosure value. Entire buildings are going dark at night. Drive the strip after midnight and count how many towers have 90% of their windows blacked out. That's not normal in Las Vegas. That's the visual proof of mass capitulation. We've seen this movie before. In 2008, condos were the first asset to crack, and they fell the hardest. Some towers lost 70 to 80% peak to trough. Entire HOAs went bankrupt, and owners mailed keys to the bank because it was cheaper than keeping the lights on. A lot of people are saying this time is different, but the ingredients are actually worse. Buildings are 15 years older, deferred maintenance is a ticking bomb, HOA fees are double what they were back then adjusted for inflation, interest rates are higher, and the buyer pool has evaporated overnight. Back then, it took about 18 months from the first crack to total bottom. This time, with everyone glued to Redfin, Zillow, and TikTok real estate accounts, fear spreads at the speed of fiber optic cable. We could see full panic selling inside 6 months once the first wave of casino layoffs hits and the January convention calendar comes in weaker than expected.
If you're sitting on a Vegas condo right now, run the numbers cold. Negative cash flow on the rental, 6-figure potential special assessments looming, declining resale value, and no realistic buyer pool in sight. Thousands of owners are already living that nightmare, and thousands more about to wake up to it. The data doesn't lie, the empty lobbies don't lie, the dark towers at 2 a.m. don't lie. This isn't fear-mongering. This is what's actually happening on the ground, while most of the local news is still pretending single-family homes holding steady means the whole market is fine. Condos have always been the leveraged bet on Vegas. They skyrocket first in the boom, and they get obliterated first in the bust. And right now, every indicator is flashing crimson. So here we are in late 2025 watching the first dominoes fall again. The question is how deep this goes and how fast. History says very deep and very fast once momentum turns. If you found this breakdown valuable, destroy that like button, drop your thoughts in the comments, share this video with anyone you know who owns or is thinking about Vegas real estate, and subscribe because I'm going to be tracking this collapse week by week with fresh data straight from the MLS and county records. The next 12 months in Las Vegas are going to be wild, and you do not want to miss what's coming. Stay sharp, stay liquid, and I'll see you in the next one.